Please stay tuned after the conclusion of the podcast for additional important information. Hey everybody, welcome to another episode of Accrued Interest, PIMCO's podcast dedicated to serving financial advisors and their clients. As always, I'm your host, Greg Hall. I lead the wealth management business for PIMCO here in the United States. This will be, sadly, our last podcast of the year, but happily, I'm joined by our favorite, our returning champion, Marc Seidner, who's the CIO of Non-Traditional Strategies here at PIMCO. And we are going to do something that's a little bit new for us this year. Marc published a piece just in the last week or two. Marc, is that right?
Yeah, about a week or so. Yeah,
about a week. Okay, and it's called "Charting the Year Ahead." It's up on our website. We'll link to it in the show notes. But it was something that we wanted to put out there for you that maybe steps back from the ins and outs of what's going on, today in the markets, and just takes an opportunity here at the end of the year to focus on 2026, think about the big issues that we think are going to be, defining markets next year, going to be top of mind for you as advisors and, of course, for your clients. And it's just a great rundown, really quick, efficient, thought-provoking, as you think about preparing for the coming year. So we are recording this. It's good that we're stepping back because I think we're recording this on Fed Day.
Yeah, we are indeed. Fed hour, I think. Actually. Yeah. Technically Fed hour.
So we'll finish this, and then you'll hop back up to the trade floor, and we'll see where the governors have come out for this round.
I'll run on up to the trade floor and absorb the press release and listen to the press conference.
I should also say we're in the middle of we're to the tail end of our cyclical forum, which
correct
frequent listeners will know is our sort of quarterly meeting that we do internally as a firm to really think about the world and where things are going. And the cyclicals that we do have about a 6-month time frame on them versus our secular, which we do in the spring, that takes more of a 5 or a 10-year time frame. And it seems to me. We've got our views about what the Fed might do today, but it doesn't seem like we're overly levered to any specific outcome. There's a lot of opportunity in our space, and I think the theme of this meeting, really reinforced that.
I think that's right. Yeah, I think that's exactly right.
Yeah, and that gives us the space we need to talk about some broader topics.
The range, yeah, we can range.
I thought I heard you say rage. And that would be a totally different style of podcast.
2022 fixed income managers had a lot of rage.
I was going to say 2020, 25.
2025, we've got a lot of range. Yes, indeed,
Okay.
Indeed.
Good. All right. Well, speaking of range, that's great. The piece is really broad ranging, and let's do something that we don't often do as fixed income managers. Let's start with equities. Let's talk about the equity market in 2026 and how we're thinking about that.
Well, it's obviously an important question on a lot of investors' minds. I mean, as we think about 2025, it's been a remarkable year to be an investor.
Yeah.
I mean, everything has done well. Almost everything has done well. Whether it's equities, U.S. equities clearly have continued their streak of strong performance. Narrow. Somewhat mixed, and I think we'll talk about that in a second. Global equities have done extraordinarily well. Fixed income has done great, right? I mean, we've got plenty of portfolios around this building and around our global offices that are up 6, 7, 8, 9, 10%, which is well outpacing cash, as we all know, and I'm sure we'll
equity-like returns and fixed income.
Equity-like returns, right? and it's funny, we've been talking about that for a couple of years now, and. 3-year trailing returns of 8% for a lot of our portfolios are equity-like returns. Yeah. And as we've said, in a broader asset allocation, fixed income and starting yields are kind of making it easy in some regard. But then you range out to things like commodities and gold that is up 50 plus percent. But specifically on equities, look, you mentioned that we're wrapping up our cyclical forum and our quarterly strategy meetings, and our views in terms of the macro backdrop continue to be quite supportive for equities. We will probably end 2025 slightly below trend growth in the United States. Inflation still elevated, but the volatility of inflation is coming down, which is I think quite reassuring for markets. And 2026, we look for inflation to continue to moderate, and growth, it'll be mixed. Probably some data points of stronger growth in the first half, largely as a result of one big beautiful bill and its provisions kicking in. Maybe a little bit more softness and some payback in the second half of the year. But we're looking at 2%. Growth in the United States, or something around 2%, which is trend-like growth, which is exactly fine. I mean, it paints an exactly fine backdrop for investors and for investing. Our only concern about equities is that valuation continues to look a little bit stretched. I said in a call recently, I made I don't know if it was fortuitous or not, but I decided to be an active fixed income manager when I started my career 36 years ago. And it feels like a better and better choice these days. I mean, I think most active equity managers have one job, and that's to think about 7 stocks.
Right.
And that's tough, right? With a starting point with a strong fundamental story, but also a valuation that is quite extended. And I guess our point on equities is 2026 could very well be another pretty good year for equity investors, but we'd make a few points there. One would be that, again, the starting point of valuation. Take the Mag 7. I mean, you're talking about mid upper 30 times PE ratios.
Where there's an E.
Where there's an E.
Sorry,
right?
maybe not in the Mag 7, but yeah, I'm making the broader point. Yeah,
and that's obviously pretty lofty. It's not .com like early 2000 valuations of that cohort of equity, which were 50, 60, 70 times, but it's certainly elevated. I guess your point was when you look under the surface, there's plenty of companies and industries that are perfectly healthy, that sport mid to upper teens type valuations. And then when you extend the aperture and look globally, there's plenty of bourses around the world that, again, have mid to upper teens type valuations with a supportive macro backdrop of trend-like growth and continuing to moderate inflation, and central banks that are likely to continue lowering short-term interest rates and monetary policy. That's a pretty decent backdrop for equities more broadly. But again, the two themes that we would reinforce would be one of looking at value rather than momentum as a key factor in committing capital, and looking around the world to diversify globally.
Yeah, broaden out the index has narrowed, whether you like it or not. The index has narrowed your exposure to equities, and so you may need, as an advisor, maybe a call to intentionally broaden out your exposure to other parts of the market. We had Cameron Dawson, who's the CIO at New Edge, on the pod a couple episodes ago. You know Cameron.
Yeah.
You spent time with her, and she spoke really eloquently just about some of the circularity in investment spending in AI, and how even within the Mag 7, you have historically capital light. She referred to them as monopolistic businesses in the sense that they had a lot of pricing power and network effect driving their business models. And now that's being transformed into something that's far more competitive, far more capital intensive as they pursue AI investments, something we're quite obviously familiar with. We've financed, some of that. We can talk about that. Do you have a view on the valuation, the expectations, the fundamental story behind some of these high-flying stocks, and do you think we'll see some resolution to that tension as we go through 2026?
Well, the interesting factor about 2026 is there's a lot of unanswered questions from 2025 that will likely I don't know if they'll get answered, but we'll certainly have more data and more evidence that points you in one direction or the other for an answer. I mean, from a macro perspective, if you actually look at the data, and it's the change in capital expenditure in the United States as an example, all of it is technology.
Yeah.
All of it's technology. I mean, the rest of the economy, in terms of investment spending and CapEx, the rate of change is almost exactly zero.
Mm-hmm.
And one of those questions is, how sustainable is that from a macroeconomic perspective? Specific to AI, the AI investing cycle, a boss of mine early in my career, I think the name of the book was "Who Moved My Cheese," and you sort of talked about the circularity, and in some regards, there's just cheese being moved around the plate from one person who's eating to the next person who's eating. And I suppose we will have to have some answers on that regard. There's macroeconomic questions. There's also investing questions. I think that our general sense is that what differentiates the mid-20s or the mid-2020s versus the early 2000s or late 90s and early 2000s is a lot of the investments coming out of free cash flow. Mm-hmm. And that is still, it's narrow in its scope because it's, a handful of companies. And as long as that investment spending is coming out of free cash flow generation and not debt and leverage, it's still a relatively healthy environment. What we might be on the precipice now is that shifting, right? That in particular for specific companies, and I won't name the name, but there's one who's been in the press where their CDS spreads have widened a lot, almost as the anti-AI play or the anti-AI hedge. Mm-hmm. I think most of your listeners will know who we're talking about. But so one of the questions will be to fund this massive amount of capital expenditure, will that shift at some point in 2026 from free cash flow to requiring a bit of debt financing and leverage, or maybe more than a bit of debt financing and leverage? And that will probably change the landscape. You're starting with high valuation and perhaps deteriorating fundamentals, even though there's this great hope of AI. That's a question that we'll probably have greater evidence of and an answer towards as we head into 2026 and further into 2026.
Yeah, and I guess in a very simplistic sense, the whole point of an arms race is that not everybody wins.
Oh, yeah.
Right.
Yeah.
And
yeah,
so
absolutely.
We'll see some differentiation.
And you wonder in this instance, technological disruption is not new to us, right? Yeah. And it's interesting, and this is slightly off, maybe not slightly off topic, but, one of the founding tenets of PIMCO's new normal view from 2013, 2014, and this was the idea that neutral levels of real short-term interest rates were quite low, call it 0 to 50 basis points, and part of it was an aging demographic and the need for income, which represses yields and represses income. Part of it was technological disruption, that uncertainty that is created because of it, and this winner take all type mentality, because as we know with technology, maybe the first person wins, but with regard to data and large language, a lot of this can be replicated very quickly. Yeah. And so it's more like the first mover benefit becomes the most efficient mover benefit, benefits to a high degree, and that I think is an interesting question.
Yeah, and moving at a pace that doesn't allow for a lot of conversations like this on reflection of what's going on. Let's leave equities and we'll come home a little bit, talk about fixed income.
Yeah.
Topic I'm pretty sure I don't need to prompt you on, but how I think one of the most interesting dynamics that we're talking to a lot of clients about right now, and sort of, I should say we've been talking to clients about this going back a few years, saying, hey, it's coming. We've now finally seen a resumption of Fed cuts. We may see another one this afternoon. And the differential between cash and what you can achieve further out on the yield curve, is becoming more and more stark. We haven't seen a massive move off the cash sidelines. In fact, money market funds topped 8 trillion a little while ago. At the risk of previewing what I think you might say, I think that we would probably advise advisors and their clients to be looking a little bit more carefully at their cash balances relative to what they can do further out the yield curve.
It is Alan Greenspan, the former chair of the FOMC, used to use the word conundrum, and I would probably use the word conundrum with regard to exactly that dynamic that you just mentioned. I mean, I know that this is a podcast, so it's all audio and not visual. But as you said, $8 trillion sitting in money market funds. I get this crazy look of bewilderment on my face. It's like the spiral eye emoji that we all use with our kids probably more often than anybody.
I can confirm that for the audience.
Yeah, it was.
You look confused.
It was literally the spiral eye emoji looking back at you, and I mean, we hear from a lot of folks, that they're perfectly comfortable rolling over T-bills or as you said, with $8 trillion sitting in money market accounts, that's sort of their comfort zone. And we just don't understand that comfort zone anymore. It made perfectly good sense when T-bills yielded 5.25%, and they were the peak of the yield curve by tens, if not hundreds of basis points. That's just not the case anymore, right? I mean, we had a Fed easing cycle or rate cutting cycle in 2024, and as you've said, it's resumed in 2025. We've already had 2 rate cuts. We probably may very well, actually, who really knows, get another one today. But that, I think, masks the point that rates will continue to normalize. The Federal Reserve and other global central banks will continue to bring down short-term interest rates. And so that 5.25 T-bill yield is now 3 3/4, and probably by the end of next year going down to 2 3/4 or 3%. Now, that stands in stark contrast to high-quality fixed income portfolios that we can structure. A lot of folks ask, have we missed it? Like, bonds have done well this year. Have we missed our opportunity to deploy money out of cash or out of T-bills or out of money market accounts into something else in the fixed income universe? And the answer to that is absolutely not. There's plenty of portfolios. I run a portfolio, you know it, that is AA- average credit quality, so a high-quality portfolio, a very liquid portfolio, 3 to 3.5 years of duration, so right in the sweet spot of the yield curve, and it yields 6.5%. And with this sort of this volatile environment that's giving an active manager like PIMCO a chance to, pick and choose what looks cheap, what looks rich, and pivot and redeploy and capitalize on opportunity and interim periods of volatility, that 6.5% yield might just be a starting point in terms of potential return. And so the answer, the answer to your question or, my comment on conundrum is this is a conundrum, right? Yeah. Why sit in something that is going to yield much, much less when you're foregoing the opportunity to lock in, at least for the next 2, 3, 4 years, a highly elevated level of yields and potentially deliver really strong returns? And then bridging to the equity discussion that we just came from, look, the backdrop seems fine, but there's plenty of scenarios, given the starting point of valuation, where equities do less well. And as we're seeing, that correlation, that stock-bond correlation, which didn't look very favorable for bonds in 2022, is once again looking favorable. So you're getting high starting point of yields, a lot of carry on top in addition to cash, and the benefit of diversification. To us, that's sort of it's a call to action if more than anything else. You haven't missed it, but if you're still sitting in cash at the end of 2026, you might very well be disappointed with your results.
I think the analogy that you've used in the past, which I've really liked, because it really crystallizes it for kind of anybody just going about their day to day, was we all watched in 2021 end of 2020, as rates came down. And what did we all do? We all ran out and refinanced our mortgages, and we locked in the liability at a level that we rationally expected to be maybe the best level we would see kind of over our investing, living time horizon.
Yeah, exactly.
And today's markets sort of present investors with the opportunity to do something similar on the asset side.
100%. I mean, all the smartest people we know, whether it's on the individual side who refinanced into a 2 or 2.5% 30-year fixed rate mortgage, or whether it's smart folks we know that run businesses and termed out 2 and 3 year borrowings into 20 or 30-year borrowings, looked really smart. I mean, those mortgages, that 2.5% mortgage that all of us have, or many of us have, trades at 80 or 85 cents on the dollar. That's an asset, right? You want to keep that thing.
Yeah.
And I think when we look back at the end of 26, 27, 28, the smartest people we know.
Think about how that translates. You paid 15% less for your house.
Yeah. I mean, somebody gave you, let's say your mortgage is $100,000.
Yeah.
Right? Somebody gave you $100,000.
Yeah.
That's now worth 85. Their asset is now worth 85.
Yeah, you could pay them back 85 and they'd be happy.
They'd be happy.
Yeah.
If you could actually do that, that's what you tell folks to do. And but folks that are sitting in cash have a chance to do that, right? They can turn that mortgage, or companies that are sitting in cash can turn those 20 and 30 year, financings into positive carry by locking in AA- average credit quality, 3.5 years of duration, 6.5% yield. I mean, and it's a world turned upside down because you don't normally get a chance to do that.
And then 3.5 years of duration, I guess one of what we hear from advisors sometimes, that they get a little nervous about the fiscal situation and how sustainable is spending, how worried should we be about the long end of the curve. You're not at the long end of the curve.
No. In fact, I'm blessed with the ability to run a flexible portfolio that is actually short the long end of the curve. Because one of the dynamics that was a strong dynamic post-Liberation Day in 2025 that may reassert itself in 2026 is the steepening of the yield curve. And we've seen this we've seen this a little bit here in the United States. Fed has cut short-term interest rates 50 basis points. 2-year, 3-year, 4-year maturities have been quite well anchored. 10-year yields are actually higher than back in September when the Fed started easing. And you're seeing that not just here, but you see that in Australia, you see that in the UK. We call it technically fiscal dominance. Your clients and advisors would likely call it concerns about debt and deficit dynamics. Yeah. The beauty of a 2-year bond is in 2 years you get your money back, and you can decide what you want to do with it, whether it was a good investment or a bad investment. Yeah. Problem with a 30-year bond is in 2 years you got to wait 28 years to get par back. Yeah, and so we would definitely not. Again, there are folks that have liabilities that need to be matched that are long duration. Yeah, absolutely, go for it. But for individuals and for advisors, stick to those 2 to 5 year maturities because they are anchored by a Federal Reserve that's going to continue to lower short-term interest rates rather than unanchored by poor debt and deficit dynamics.
I think it's across the platform. I think we're, in the 4, 5, 6. I haven't seen a lot of numbers bigger than that at this point. We'll take a break from fixed income. Uncharacteristically, let's talk about real assets. Gold has been an unbelievable story this year. It's still hovering kind of near its highs, maybe off a little bit. For a while, Bitcoin was pacing it, kind of penny for penny, and people were talking about Bitcoin as our new reserve, our new store of value. That story has come. Well, we'll see. It is temporarily maybe lost a little bit of its strength with Bitcoin down, looks to me about 30% the last couple of months. But let's talk about the commodity space. Let's talk about real assets. How are we feeling about opportunities there, and then maybe how they fit into a diversified portfolio for an advisor?
I mean, I guess that one of the main points we would probably make, and we've sort of touched on this in equities, right? diversification into the sort of the value space. Talked about it in terms of global diversification. We'd say the same about fixed income. Global diversification is a key theme across many of our portfolios. And we'd say the same across a broader asset allocation, diversification. And I think that's where commodities come into play. It's not just about gold. It's about a broad swath of commodities. On gold in particular, first of all, in our metrics of valuing gold relative to real yields, right? Because it's just a real asset. Actually, inflation-protected bonds or bonds more generally look a little bit more attractive. Doesn't mean that gold can't continue to go up in price, but potentially on a risk-adjusted basis that bonds could do a little bit better. When we were writing this piece, we sort of came across the fact that central banks now own more gold than they own treasuries. Interesting, right? And that's probably creating a little bit of that richness. And I think you're right. Like, in that theme of diversification, that concept of diversification, in the idea of again, bridging one of the things we just talked about, bad government debt and deficit dynamics, you're looking for something outside that system. It feels like for a younger cohort, that is cryptocurrencies, and that's perfectly fine. Volatile. It's a volatile asset, as we've all realized recently. But it is a medium of exchange that is different than sort of fiat currencies, and so it's totally understandable. Gold is the more traditional diversifier, and can and should continue to do well in 2026 and beyond. But in addition to just thinking about gold as that diversifier, a broader exposure to real assets, commodities more generally, to us is a prudent strategy.
Yeah, I mean, intuitively for me, the utility case for gold, it is an interesting one. After sanctions were imposed, post-Ukraine, the U.S. began seizing assets internationally. Central banks just looking, effectively not to rely on the Western banking system as a store of value and beginning to store value in gold. And so utility increased. Bitcoin, I will reserve judgment on. I'm no expert and I'm prone to skepticism. So I will keep my tongue.
Don't be so old fashioned.
Yeah, exactly. That's right. But I think, in the broader commodity universe, one of the things that always appeals to me when thinking about that is that they can be used. Oil can be used, metals can be used, rare earths that we've seen, of course, in the news a lot recently can be used. And I think in the piece, you guys do a nice job of just saying, hey, this universe is broad. There's lots to do, and a broad commodity exposure can.
I mean, and this is a concept that goes, way back in my time in sort of thinking. But as we as individuals think about our own asset allocation, we should think a little bit about our liabilities, right? And one of our big liabilities is energy, right? And we've got to heat our houses, we've got to cool our houses. That's oil, that's natural gas. We've got to fill our tanks. That's unleaded. I think most of us are unleaded, or we got to power our cars, and that that is coming from electricity, which comes from still a decent amount of fossil fuels. And so it makes sense to have a little bit of commodity exposure in your asset allocation just to hedge some of that risk, some of that price sensitivity. And we're not talking about a lot. I think we're talking about, a little bit can go a long way. It's the same with global diversification. I mean, to the extent that there are folks that want to travel overseas, right? If the dollar depreciates, which is another sort of, theme of ours, then our purchasing power goes down. So having a little bit of global asset in your portfolio, whether it be equity, whether it be fixed income, I think also helps, put in perspective hedging your own sort of forward liabilities or your own need for return. Because if energy prices go down and you have a little bit of commodities in your portfolio, you might feel bad about it looking at your statement, but when you go to the gas station to fill up your tank, or when you get your heating bill, you'll be quite happy. Same with if you want to plan a trip to somewhere else over the summer, if your global diversification goes down a little bit in value, again, you look at your statement and be like, oh, that's a shame. But you will feel great getting a hotel room or buying a meal.
I don't fancy telling my wife that we can only go to those places where I own the currency in the portfolios. Like, sorry, honey, like, we had a view on the sterling, so we can only go to the UK. Well, Europe's out.
I just came back from a trip to London. It'd be great if you're stuck there for the rest of
we took my mom. We took my mom to Oxford and the surrounding area for her 75th birthday. So,
well, happy birthday to your mom.
Happy birthday to my mom. All right. That's great. We're going to keep going around the world. I think this is one of the most interesting topics, and one where I personally think we're going to start to see a lot of data points in 2026 that help to answer questions that have been raised in 2025. It's credit, and that's obviously broad credit markets, but maybe with a little bit of an emphasis on private credit and direct lending. They've been so much a part of the headlines over the last couple of months. Talk to us about your feelings on broader credit, and then let's spend a little bit of time on developments on the private space.
Yeah, I mean, credit, public credit, investment grade, high yield, similar to equities, the valuation is quite extended. For those of you that know us well, you know that we often quote percentile rankings of spreads or risk premia, and for both investment grade and high yield, you're in your lowest decile of attractiveness over the last 10 years. So there's a lot of good economic news priced into credit markets. Again, fundamentals are exactly fine, but valuation is exactly unattractive. So we would comment on two things. One, there's a lot of other sectors of the global bond market and the U.S. bond market that look much more attractive. And as you know, we've been heavily invested in either mortgage-backed securities or asset-backed securities because their valuations have looked much more attractive to us. It's worked quite well this year, and that gap has narrowed a decent bit, but there's still a gap. And so we'd much rather have sort of the security of a mortgage or an asset-backed security versus unsecured corporate credit at a more attractive yield spread or risk premia, and that largely continues. So again, we look for opportunities outside. That does not mean that there aren't attractive bonds, right? And that does not mean that you can't find attractive credits to invest in. But active management really does matter, and active selection really does matter.
And if I can offer, it also doesn't mean we can create those opportunities. This isn't a PIMCO advertisement, but with scale comes the ability to go to an issuer and look to do something creative and compelling at a really large scale and create some excess return out of it.
Well, that's a super interesting dynamic, right? Because they're up until probably within the last few months, right, there was this either or, right? You were either a public credit investor or you were a private credit investor. And I guess one of the points we will make is that the private credit markets have existed for decades. This is not a new thing. This is not the new theme, right? I mean, it was originally, when I started my career, when you started your career, it was called 144A issuance that would circumvent sort of SEC registration to bring a debt deal to market, and you would get paid an excess risk premia for what was a less potentially at the time, not so much anymore, but a less liquid security, and that's our that's sort of our theme, our battle cry, which is just don't compartmentalize either or. Find something that has the ability to range between the two and look for the most attractive valuation, look for the most attractive opportunity, whether it be in the corporate spectrum, whether it be in the mortgage spectrum, whether it be in the real estate spectrum, and whether it be a fully public issue or something that is a little less liquid. There was a well-advertised transaction that we've done recently where we were picking up hundreds of basis points relative to where that risk would price in the public corporate credit market, and that worked to our advantage. And there'll be plenty more of those opportunities in 2026.
Yeah, I think it's interesting because the wealth space in particular has become the locus of a lot of the fundraising in quote unquote, private credit. And when I say private credit, what I really mean is direct lending. Lending to companies that are being acquired by private equity sponsors or going through some other kind of transformation. And that introduces sort of a new factor that we have to evaluate, right? It's not just about the fundamentals of the economy. It's not just about the fundamentals of the underlying credits. It's about this new investor base who's kind of being exposed to this asset class for the first time in real scale. And, you spoke about conundrums earlier, and maybe I'll be a little more provocative than I actually feel about things, but I feel a conundrum right now, given the amount of direct lending fundraising that is still going on. If I came to you, Mark, and I said, I've got a great opportunity for you. Here's what I'd like you to do. I'd like you to invest in this security. It's floating rate. So it tags to the part of the yield curve that's coming down. As rates come down, so will your coupon. It is at the lower end of credit quality, more highly levered companies with some potentially optimistic assumptions built into them by their acquirers. It sits outside, the traditional high yield or bank loan markets, so it's sort of, by definition, it's a little bit lower quality. There's a lot of competition in the space, and so can't quite get the terms and the covenants that we used to get. So it sort of prices on top of some of the other stuff without some of the bells and whistles that it used to have. Oh, by the way, you've read the headlines. Maybe your clients might be concerned about, what's going on underneath the portfolio. We may see rising credit costs. That's not just me saying it. It's some of the alternatives guys have been out there, citing that as something that may happen in 26 and beyond as well. But here's the kicker. It's illiquid, and your ability to get out of this investment is contingent on other people's decision whether or not to get out of it. And it will largely be marked at par until such time as it is not.
Right.
And it's a conundrum for me to understand how that competes with a more liquid, higher credit quality security that is actually out yielding and outperforming. And look, maybe that's just my diatribe and my confusion, but I am kind of curious about how you reconcile that dynamic in the marketplace right now.
Well, I think you pretty much answered your own question.
I do that sometimes. I do that sometimes.
The only thing I would add is, I don't think it's a conundrum at all. Like, I actually don't think it's a conundrum at all. A lot of investing is based upon, trailing returns, right? And great marketing pitches. And, in a world of rising interest rates, floating rate debt looked really good, right? When you start at 0 and you go up to 5.25, right? And with a spread, even if it's not that attractive, your total returns look, or your income returns look quite good. When you're not marking to market in a good investment environment, information ratios look spectacular, right? Return per unit of risk, right? Your return is going up because short-term interest rates are going up. You've got a reasonable spread because underwriting back then was a little bit more underwriting, 4, 5, 6 years ago was more disciplined, and you weren't marking to market, or you were barely marking to market, and you had so you had good numbers, good returns, low volatility, high information ratios, and of course it looks good. I mean, what we do is we look forward, right? Mm-hmm. And we say, and that's what everybody should do. And we say, well, as you said, short-term interest rates are coming down, right? So your return is going down. Your spreads are narrower, and I'll come back to that in a second. And so your return is declining vis-a-vis the last 3, 5, 7 years, and your risk is going up, right? Because we know that the fundamentals for small and medium-sized enterprises continue to deteriorate, and there's more and more signs of trouble. We call them cracks in the sidewalk. Jamie Dimon called them cockroaches, right? I don't know if they're cracks or cockroaches, but either one will work just fine if you're thinking of the analogy. And Dan Ivison, who all of you know, uses this, makes this comparison to the consumer and subprime in the 2000s, when you have too much money chasing too few good ideas. You're either pushing down and investing in less good ideas, or you're pushing your risk premia or your spread down, and both of those are bad. They potentially foreshadow, a much less appealing.
Yeah,
I'm trying to be kind here.
But Dan says disappointing.
Much better outcome. Much worse outcomes. Yeah. Whether it's a fundamental downdraft that causes real principal loss, or whether it's just less attractive returns, I don't know. But if we're forward looking, we want to lock in attractive yields, pick and choose where we think we're getting paid an attractive risk premia, and hopefully harvest terrific returns for the next 3 to 5 years.
Yeah, and preserve the ability to change our minds.
Correct.
Because the environment's moving around. Yeah, I think the other thing that you reference in the piece is the best proxy we have for market pricing on some of these direct lending private portfolios are the public BDCs, which are trading on average, not all of them, but on average, at a meaningful discount to par, which is where the private ones are marked. So the market's telling us some combination of the factors that we've referenced here. They've concluded that they don't want to pay $1; they want to pay 90 cents or 85 cents to access that cash flow stream. I just observe. I feel like markets don't love an arbitrage. It's not perfect arbitrage, but it's close. And so that feels like something that's got to resolve itself, in the coming months and maybe 2026.
I think that's right. It's probably a little bit of everything, right? A rationalization of credit, some evidence of deteriorating fundamentals, and more realistic marking of portfolios, right? I mean, we see this in secondary portfolio trades all the time. There's a wide bid offer, and that as that bid offer narrows, that means that alternative asset investors, direct lending portfolios are going to have to be marked more reasonably. And by the way, that's quite healthy for an industry, right? I mean, that's very healthy for an industry, and we would welcome it because it sort of speaks to that public-private continuum, right? It's not either or. It's just what is the most attractive deployment of $1 of capital on any given day, rather than set it and forget it, and hope the crock pot cooks you dinner by the time you get home. And you're either going to end up with rare meat or mush, and I don't know which one's better or worse. It's probably a terrible analogy, but I'm going to go with the crock pot.
I do think the
Greg, I'll go with the crock pot for $200.
I think I won't make a cooking analogy. I agree with you entirely that price discovery is a healthy mechanism for markets right now, and what we don't have.
By the way, PIMCO was founded 50 plus years ago by a guy, everybody knows Bill Gross, who got tired of sitting in a vault clipping coupons on bonds and mailing them in, hoping he got a check, saying there's got to be a better way of trading this, right? Of price discovery and capitalizing on opportunity, and it's almost back to the future, right? That's exactly right? Mark things to market, make investment decisions, deploy capital based upon fundamentals and pricing, and then adjust and then have the flexibility to adjust when fundamentals change and or pricing changes. And I go back to your question. I said, I think you just answered your own question. That's the answer to the industry.
Yeah. Yeah, I think people have become very enamored of the NAV that rarely changes. And so that transition to a more market driven or price discovery driven process could be bumpy. And so
Yeah.
it's something for people to think about as we think about 2026.
Well, again, I mean, let's again, there's increasing numbers of headlines of idiosyncratic risk, right? And one of the things we haven't touched on is, I feel quite strongly about this, and we talked about this week. We are definitely in a K-shaped economy. Okay, maybe definitely is too strong, but I think there's evidence that we're in a K-shaped economy.
To define K-shaped, because this is a really interesting. I heard you on this topic earlier this week, and I'm really glad you brought it up. But just for anybody listening who doesn't immediately know what we mean by that term,
So just picture the letter K.
Yeah.
Right. There's an upward sloping line and a downward sloping line, and picture the economy and think about it in terms of, size. Like the large economy, meaning, large, high quality companies and the upper income, the top half of the income earners are doing very well. Part of that is, asset price appreciation. Part of that is, economy that's favoring the larger. The bottom spike of that K is actually doing quite poorly. And you see that fundamentally in charge-offs and delinquencies to the lower income cohort. The bottom two quintiles of income earners are struggling. And you also see that on the corporate side, right? Small and medium-sized enterprises, companies with, call it less than 100 million in EBITDA, are quite frankly not able to pay their quarterly or semi-annual interest payments. And I mentioned this, or we mentioned this in the piece. 11.4% of companies in that cohort are now picking on their debt. They're paying in kind, which means I'm calling you up and saying, Greg, I'm sorry, I don't have the money to give you the interest from the interest on the money that I borrowed from you. But good news is I'm not going to default. I'm just going to tack that on to the final maturity payment. That's kicking the can down the road.
Yeah.
And when you do the simple math, 11.4% of companies in that cohort who don't have the cash to cover their interest expense, that's 1 in 8 small and medium-sized companies. Now, 50 to 60 million Americans are employed by companies that have less than 50 employees. That's exactly that cohort. And so it's both, I think, a fundamental concern, but absolutely a warning sign for this direct lending cohort, which is why BDCs are trading at a discount, which is why publicly traded alternative asset management firms have their equities have done poorly this year off of a relatively high base. And again, this is, I think, another one of those questions that's definitely going to get answered in 2026, whether or not that K-shaped economy is real, which I think it is, and whether or not it means anything to us investors, which I think it does. Again, cracks in the sidewalk, cockroaches, whatever you want to call it, to me, it's real.
Yeah, and it again, I mean, it invokes the topic of active management and choosing, as investors, however we might think, especially this time of year, how we might think about that personally, socially, politically, about, those less fortunate than the upper part of that K, from an investment perspective, how do you want to be allocated? Where do you want to pursue safety? And I think to give, oh shoot, I'm about to say to give credit as we talk about credit, but to give credit to
pun intended.
I think we'll also probably see some differentiation, a spread of outcomes amongst the direct lenders out there. There are some who have remained more disciplined, who have refused to deploy into a very competitive, difficult environment to the extent they're able to refuse with the money coming in the way that it has. And so this will be a good opportunity to sort of see, as the tide goes out, to use the metaphor I won't complete.
Who has a bathing suit on?
Yes, exactly.
Yeah.
Okay, last topic, near and dear to my heart. Let's talk about munis. This is something, it's great. We put out a lot of global pieces. We don't get to talk about the U.S. muni market in some of these outlook pieces. In this instance, we were able to make a case for municipal bonds. interesting year for munis. Never quite recovered from Liberation Day. We had what I call the summer of our discontent, where they just simply couldn't find a bid. They've come back in a nice way over the last couple of months. Do we still see value for taxable investors in the muni space?
Yeah, they've it's not quite the flashing green light opportunity it was in probably July, August, or September. That's not right. It's still a green light opportunity for sure. It's not quite as it's not quite as unbelievably awesome as it was. It was a few months ago. But there's no doubt that munis, as part, particularly of a wealthy household or a high tax bracket household, that they've lagged, and the after-tax yields look super attractive. And by the way, that's for a pretty reasonable, high-quality portfolio. Where we worry a little bit is down in credit quality, because there's been an awful lot of project finance that has happened in the past few years, and some of that is becoming quite treacherous. And so, again, it's this idea of active management, right? The general theme is that all-in yields and on an after-tax basis, munis look very, very attractive for the taxable investor. But there's got to be some element of caution out there, some element of discretion, and not, just as we were talking about in credit, not one size does not fit all.
Yeah, I think if we could give one piece of advice to advisors is, in this space, there's a temptation to pursue the highest nominal yield.
Yeah. And
that often carries you to the high yield segment. And that's where these, some of these episodic issues, the commuter train in Florida, for example, have created problems for folks. Our approach has been a little bit more risk-adjusted return oriented. But I think your broader point is that there's just a rich array of opportunities, a great way to create after-tax yield. Yep. You live in California. I live in New York. The states that are, exact their share of income for taxes. So if advisors and clients are similarly situated, it's a great place to look. The other,
well, as you say, that's what our not our risk, but our cost is the gain, right? Which is that fundamentals at a state level are actually quite good.
Yes.
Because receipts have been quite high in recent years. And while there are certainly challenges facing almost every state in the union, fundamentals are quite strong. Yields are still relatively high. And that as a result, after-tax yields and potential returns look really good. And that's the other point. You don't have to go too far down in credit quality to get a really attractive after-tax yield. And so if the market's, we shall taketh what the market giveth.
Yeah.
And if you're not taking, then you effectively are giving. And you're giving up. It's opportunity cost. You're missing out on an opportunity.
I'm smiling because I was just thinking about your analogy with energy, previously about, we all know we're going to spend on living in our states. We might as well also benefit by investing in our states. And it's a reasonable hedge. The other thing I was just going to mention on munis, and I don't think we do a good enough job articulating this, is that market has developed to the point where there's a lot of private financing activity, and you referenced this in the piece, but some of the good parts of private credit of direct lending, exist in the muni space, and we should make clients, I think, and advisors, more aware of the power of controlling your own destiny that exists in that market. It's not all, to use your analogy, it's not all necessarily taking what the market giveth, but there's a whole segment of what we do that is actually creating opportunities, which is a nice counterpoint to
affordable housing. Fits right into that. Fits right into that.
Sure.
In that spectrum.
And a big theme in our portfolios.
Big theme in portfolios and products and product generation. I mean, it's just, again, like you're getting a good return for giving something back.
Yeah.
Win-win.
Yeah, what a nice thought to end the podcast on as we head in to the holiday season. Next time we do this, we should do ugly Christmas sweaters. I know you pretty well, and I'm pretty sure you've got some ugly Christmas sweaters.
I got a closet full of them. By the way, it's nice to do this. I mean, we've done a few of these this year. It's nice to actually do it in person with you.
It is. It's nice, and it's nice that I got to come to Newport Beach, where it's 80 degrees,
it's nice
rather than my hometown of New York City, where it is somewhat less than 80 degrees, let's just say. All right. Hey, everybody. Thank you, Marc, for joining us. This is great around the world. Can't wait to do it again. We'll do it again next year, but I'm sure we'll hear from you in between. Like I said, this will be our last pod of the year. If anything that we said today interested you, please do visit us at www.pimco.com or your country's PIMCO site. If you identify yourself as a financial advisor, you'll be taken to Advisor Forum. That is our one-stop shop, our destination for you to get everything that you need to learn about markets, to explore some of these topics more deeply, prepare yourself for those end-of-year meetings we know that you're having with your clients right now. We will be back in January. We're going to kick off the year with our CIO, Dan Iveson, doing a deep dive on an outlook for fixed income markets for the year. Until then, have a restful, recuperative, wonderful, festive holiday season. Pat yourselves on the back and congratulate yourselves for the great work you've no doubt done for your clients this year, and we'll see you in 2026.
The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal pages/podcast disclosures.